In our third chapter, I will discuss with Cedric Baron of Generali Investments the nuts and bolts of multi-asset investing. Cedric, the main decision which you make as a portfolio manager, is that the decision of the strategic asset allocation?
That is clear that the strategic asset allocation is key in the multi-asset portfolios. It's define your long-term view, it's define your long-term positioning, your neutral positioning. So clearly it is key. When you design your strategic asset allocation, you design what is your risk profile. So the tactical asset allocation and any overlay you can implement in your portfolio can differentiate much more the different multi-asset funds. Yes, the strategic asset allocation is key, but the tactical and any overlay will probably differentiate your funds from the others.
And what type of factors would lead you to review the strategic asset allocation?
By definition, the strategic asset allocation don't have to be reviewed frequently. I mean, it is a long-term view, it is a long-term positioning. Nonetheless, reassessing and reviewing the risk-return profile of each asset class, at least on a yearly basis, could be of interest. It's not a problem that an asset class is facing hard time or declining over a short period of time. I mean, it is the job of the tactical asset allocation to reduce this asset class if it's suffering during a short period of time. That's not a sufficient reason to take one asset class out of the strategic asset allocation. Nonetheless, if one asset class, I would say the risk profile of one asset class is changing dramatically from time to time, or if the correlation of this asset class with the other portfolio is clearly changing a lot, yes, it would be a good reason to change the strategic asset allocation. To give you an example, for instance, if the high yield would prove to be less sensitive to growth, more sensitive to interest rates with lower yield, yes, maybe it would be of interest to reduce its weight in the portfolio I'm currently managing, because it will no longer give the risk profile I'm looking for from this asset class.
So for these more tactical elements you're talking about, what sort of role does the research, the macro level research and the trend following analysis, what kind of roles would this research play in those decisions, in those tactical decisions?
I mean, the macro analysis is very important. It will enable to analyze the economic environment and to determine, based on growth analysis, based on risk premium analysis, analyzing the central bank policies, etc., what is where we stand in terms of economic cycle, in which phase of the economic cycle we stand, and which asset class will be the most performing one in the coming weeks or months. So it will enable to be proactive, to modulate your strategic asset allocation based on your short-term views on the macro environment. The fact is, it is really important, but what is also key is the timing to play this thematic. You can have the right analysis of the economic environment, but if you don't have the right timing, you won't make money. So what is key in investing is also the timing, and that's the reason why we complement this macro analysis with a trend following analysis. The trend following analysis will just tell you what is the thematic the investors are currently looking at, what the market is currently focusing on. So both analyses, macro one and trend following one, are highly complementary. The one is clearly momentum, the other one is much more contrarian, and will enable to enhance the strategic asset allocation performance by adapting quickly to the market environment.
And how do the volatility control devices work within the multi-asset portfolio?
Clearly, the volatility control is also of high importance in the investment process. It will enable to avoid sharp drawdown, and it will enable to maintain a constant risk profile for the investor. When you invest in a stock, for instance, you buy a security which will have a very different risk profile if you buy it in 2006, you hold it in 2006, 2008, or 2014, for instance. You hold the same security, but at the end, you have a very different risk from time to time. With the volatility control, in the fund, we do the job for the clients so as the level of risk in the portfolio remain the same. So we kept the volatility at a 6% maximum level, and we make an arbitrage between risky assets and cash in order to keep the fund volatility below this 6% level. It's an efficient way to avoid any sharp drawdown.